Good afternoon, everyone. Thank you for joining us today for our webinar on IME Concentrated Microtrends. My name is Deepak, and I'm pleased to be your host for this event today. Before we begin, I'd like to take a moment and to provide some background about our speaker and the investment strategy. Our speaker today is Ashi Anand, the CIO and fund manager of IME Strategies at Valcreate PMS. With over 2 decades of fund management experience at some of the top institutions like ICICI and Kotak, Ashi has a proven track record of consistently outperforming the markets during the course of his career. Today, we'll be discussing the merits of IME Concentrated Microtrends PMS strategy, which is a large and mid-cap oriented strategy aiming to identify certain micro trends that are playing out in the larger macroeconomic trends within Indian markets over the next 3 to 5 year time horizon. And he aims to take positions into companies that would benefit from these micro trends. During the webinar, we will explore the strategy in detail and discuss how it can be incorporated into your investment portfolio. To give you an idea of what to expect, we'll start by providing an overview of the strategy, its benefits, followed by a discussion of its expected performance. We'll cover some case studies of successful investments and answer any questions you may have. With that said, let's get started. Ashi, over to you.
Thanks a lot for the introduction, Deepak. Thank you, everyone. Thanks for joining this webinar. So over today's webinar, we will be discussing our concentrated microtrends strategy at Valcreate PMS. Without further ado, I'll just go ahead and share my screen and take you guys through the presentation. So the IME Concentrated Microtrends strategy basically aims to take concentrated exposures to value-generating microtrends. What the strategy basically does is, so what is a microtrend initially, right? So within an economic megatrend, the strategy seeks to identify the specific subtrends, what we call microtrends, that have the greatest growth and value creation visibility. And according to us, these concentrated exposures to value-generating microtrends is what can help drive significant portfolio outperformance. We will discuss in greater detail what is a microtrend and what makes investing in these microtrends so attractive. The investment philosophy basically has a balanced approach towards 3 key stock selection criteria: growth, quality, growth, and valuations, with the focus being on investing in high-quality businesses with clear growth potential that are available at the right price. We have a very rigorous investment process, which includes the use of a proprietary research management solution, which basically helps drive much superior investment decisions. We'll take you through some of how this investment process works. And we'll also go through what the team is. But just to give you a brief highlight, the core investment team has over 5 decades of fund management experience across some of India's leading AMCs. This includes ICICI, Pru, Kotak, HDFC, and Larsen. Also, the portfolio construction will focus on concentrated investments in 20 to 30 companies across 5 to key microtrends. So this is a brief overview of what the strategy is and what we'll be covering. Now, let's just first understand what is a microtrend and what is the investment rationale for microtrend investing. So the IME microtrend strategy will basically take concentrated exposures to value-generating microtrends. Now, in any economic environment or any market environment, there are always certain specific parts of the economy or market where the majority of the value creation is taking place. There are always going to be parts which are growing faster and parts which are growing slower. By taking concentrated exposures to the specific trends with the fastest kind of value creation taking place, you can get substantial outperformance to the overall markets or diversified portfolios, where the performance of such markets or diversified portfolios is actually dragged down by the slower moving parts. This strategy basically aims to deliver superior risk-adjusted returns. By taking a concentrated investment approach to specific microtrends, we believe we have the ability to deliver outperformance by investing in high-quality large and mid-cap companies. This leads to superior risk-adjusted returns without having to resort to the inherent risk of investing in small caps or lower quality companies. Very often, fund managers having to resort to a higher exposure towards small caps, and that comes with kind of various kind of incremental risk. By just taking concentrated exposures to the parts of the economy and market which are growing faster and not having exposures to other parts, we believe we can actually deliver the same levels of outperformance without having to take some of the risks which are inherent with either investing in small caps or lower quality companies. Now, in order to understand a micro trend better, it's useful to kind of understand how a micro trend differs from a macro trend or sectoral or thematic funds. This is best understood with the help of an example. So let's look at the financial services sector in India. Now, structural reforms and strong demographic dividends in India are macro trends that are aiding this growth, right? So structural reforms, demographic dividends, these are examples of macro trends. Now, the BFSI sector or the financial services sector in India can be broken up into banking, NBFC, capital markets, and insurance industries. So these are examples of industries. Now, micro trends are basically narrower parts of these sectors, industries, or trends where specific trends are playing out, leading to more attractive value creation. Now, examples of this within financial services could include the whole asset quality normalization theme that you're seeing play out in India in corporate banks. As you've seen from 2015 to 2020, these banks had to recognize a large amount of corporate NPAs, which impacted earnings. As these NPAs have now been fully kind of recognized, you're actually entering a period where earnings growth can be very attractive since you're no longer taking the hit of this corporate pain that you've seen in the past. You're also seeing value migration happening towards financial franchises or the financialization of savings schemes. So there are various sub trends within a larger industry or sector. And that's really what we are seeking to identify and take concentrated exposures on. Now, another key element of understanding a microtrend is that microtrends are not sectoral or thematic in nature. They're specific subparts of a sector theme or the economy where we see the greatest potential for value creation. And you could actually have microtrends sometimes which are actually spanning across multiple different sectors. Now, it's useful to kind of understand microtrends and what makes microtrend investing so interesting from an investment strategy by taking some kind of case studies. So we've taken case studies across 2 or 3 major periods of the market. So, for example, in the 2002 to 2008 bull market in India, right, this is a period where overall the markets had done extremely well. And you saw a 42% CAGR compounded growth rate in the overall markets of the BSE 500 over this period. However, what was really driving the economy and markets in this period was this whole capital markets, or sorry, capital goods theme. Very large investments happening across different sectors, which was really driving very strong demand growth for capital goods. If you had taken concentrated exposures in capital goods over this period, as compared to a 42% compounded growth, you could actually have had an 82% compounded growth, a 41% alpha on an annualized basis, and you would have been 4.4 times better off as compared to having just invested in the index. You also can see this in a number of other examples between 2008 to 2020. The way healthcare substantially outperformed the overall markets from 2008 to 2015. You saw something similar in consumer staples from 2008 to 2013. Banking pretty much through the entire decade from 2010 to 2020. And the way US tech outperformed the overall benchmark indices, again, pretty much across the entire decade. And post-COVID, you've seen something similar in terms of if you had taken concentrated exposures around IT or real estate. Now, these are specific past case studies, and you do benefit there's a benefit of hindsight when you're looking back. But very clearly, what the data does show is if you can identify the specific elements of the market that are doing better, you can actually substantially outperform. We have a few other charts which really show something similar. right? It's really the same case studies, just in a graphical manner. So this is the outperformance you saw in capital goods as compared to the overall markets from 2002 to 2008. What you've seen in the private banking space over the last decade. Now, the whole point is that there are always these underlying trends that you can identify, right? So what was happening in, say, for example, private banks is there was a very clear value migration that was taking place from PSU banks, which was struggling for capital, struggling in terms of the general dynamism of the organizations themselves. So these large PSU banks were really not able to grow. There's a large amount of market share shifting towards private sector banks, and this is what actually helped them outperform as significantly. You saw something similar in healthcare between 2009 to 2015, and in FMCG between 2008 to 2013. Now, these are traditional defensive kind of sectors. So, this period, it's the post-COVID period, is a period where really markets were not doing too much. And by and large, markets were broadly flat or relatively weak. And in these periods, in these kind of market conditions, is where you see defensive kind of companies actually outperform quite substantially. So that is the broad kind of investment thesis around microtrends. If you can identify, and that's really what the strategy really focuses completely on, identifying the pockets of growth, of higher growth within an economy, within the markets, that you expect to see outperformance over the coming 3 to 5 years is the kind of investment horizon we're typically looking at. We are not bothered about whether it's a sector, an industry, a particular macro trend, etc. The focus is on specifying those specific pockets of faster growth where you can just buy high quality mid and large cap companies and really see outperformance driven by that. And really, from a risk adjusted perspective, the returns become very interesting. We have a very rigorous investment policy and a very rigorous investment processes. One key element of this is our proprietary RMS or research management solution. This is one of the most sophisticated research management solutions in the investment industry, and it really helps institutionalize some of the best in class processes and disciplines that our investment teams follow. Now, since all data in the system is stored in a structured database, smart querying of this database allows for comparison of qualitative and insights and data across companies and sectors, which really provide a lot of valuable insights that help drive our decision making, help us identify micro trends early, etc. Right? And a lot, I think both Rajesh and I, we both come from very large AMCs with strong institutionalized research processes. We've really tried to incorporate the best practices from these AMCs and take it one entire notch further. I think the RMS and the discipline that the RMS enforces is a key element of the same. What you're seeing are just short snapshots of the RMS, but just so that you know, we look at over 250 companies, and for over 120 companies, we have very clearly detailed documented views around what we like, don't like, the outlook, the investment view, quarterly data, and a lot of other things. This is just a very small snapshot of this tool that we use in-house. Now, effectively, how do we go from this larger investment universe? There are around 250 companies that we track to identifying the 15 to 25 companies that we're likely to have in our portfolio. So there are about 250 companies that we keep a track on kind of a quarterly basis, where we are keeping track of how these companies are doing. Around a little over 120 are companies where we have more detailed coverage on. This basically includes a more granular dive into key business drivers, quarterly results, notes, company meetings, etc. Right? And these are basically companies that meet our GQV framework and are also beneficiaries of potentially emerging microtrends. From these 120 companies, we have about 50 companies that fall into a focus list. Now, this is where we undertake much deeper fundamental research. This would include the annual report analysis, management interactions. We build our own financial models. We do scuttlebutt along the value chain to really understand these businesses better. And we're really focusing on businesses within the strategy that have the strongest micro trend tailwinds and where the growth, quality, and value equation is fairly attractive. Now, from this list of 50 focus companies, the stock selection is driven by, for a company to be considered for investment, it needs to be one, a direct beneficiary of the identified micro trend. It needs to have a 4-star plus fundamental rating, and it needs to have clear upsides in terms of our price targets. And therefore, overall, it needs to fit within IME's GQV framework. Right? So that's really about the research process and how it operates. Now, in terms of portfolio construction, in terms of market cap, this is positioned as a large and mid-cap portfolio. Large caps would be between 50 to 100%, mid-caps would be 0 to 50%, and we aim to limit our small cap exposure to 20%. Now, investments accordingly focus on larger, well-tracked, large and mid-cap companies, where businesses and governance track records are clearly established. We prefer companies that we have followed closely over many years, where we have been able to build a much deeper understanding of these businesses and management quality, allowing us to manage risk while taking concentrated exposures on specific microtrends. Now, there are sector and microtrend limits that we follow. So at sectoral, there's a 30% limit ex BFSI and 50 for the BFSI sector. And we will limit exposure to 40% on a specific microtrend. The aim is to have between 5 to 10 microtrends. We may keep up to 20% of the portfolio for specific bottom-up or special situation ideas. The important point is that we are benchmark agnostic and we are willing to have zero exposures to parts of the market where value creation is uncertain. This will be a concentrated portfolio of between 20 to 30 stocks. We won't have more than 15% on an individual stock, and we have clearly defined portfolio weights at entry based on a level of conviction, risk, and liquidity. Now, let's just kind of wrap up by one, looking at the investment team and also looking at the current portfolio composition, which will also give you a better flavor in terms of what are the micro trends that we're currently betting on, and it'll really help you understand the strategy that much better. Right. So firstly, I'm going to be the fund manager for this particular strategy. I've got the 2 decades of experience in the Indian capital markets, and it's basically over a wide range of different market conditions, market scenarios, and different organizations. I have been able to quite consistently outperform the markets across a range of different market conditions. And there are the greater details on this, which are available on the presentation deck. Now, a bit about ValCreate PMS. So ValCreate stands for value creation. We got a license in 2017, and I joined in 2022 as the CIO for certain IME branded strategies. The core team, which comprises Rajesh and myself, have fairly deep institutional investing pedigree with over 5 decades of experience in some of India's largest CMCs. Now, these institutional best practices of fund management is what we bring to ValCreate. And the aim is to be able to offer differentiated investment strategies that offer exposure to specific underlying themes where we really believe value creation is a lot more possible. You'll see this is an underlying theme across the various strategies that we launch. So the aim is really to take this very deep institutional investing pedigree and be able to launch more differentiated strategies that would typically not be available in a mutual fund type of a construct. Now, what are the kind of micro trends that we are currently investing in? So at this point in time, there are 8 to 9 micro trends that we currently have exposures to. The first is asset quality normalization, lending franchises, and there's also financialization of services of savings that we've just recently got into. These are 3 within the financial space. We then also have IT services and digital disruption. We have chemicals API CRAMS, real estate, capex revival, and consumer aspirational. Now, let's just go a bit into each of these micro trends. I won't spend too much time, but just to give you some kind of flavor. But just before we get to that, this is the current portfolio composition. As you can see, we are sticking within the large, mid, and small framework that we have spoken about. And if you just look at the kind of names against each of these micro trends, Most of the companies that we've invested in are companies that a lay investor would probably have heard about. These are not small, unknown companies that haven't been around for a long time, but are really large, credible, and mature businesses. The volatility of returns accordingly in this kind of space is substantially lower. Now, quickly just coming to some of the core microtrends and what's making it so attractive. Now, this is the asset quality normalization microtrend. What you've effectively seen in banks such as SBI, Axis Bank, IDFC Limited, Shriram. Over the past decade, and especially over 2015 to 2020, there was a very sharp increase in gross NPA ratios or problem assets. This increase in problem assets led to these companies having to take very large provisions on their income statement, which really led to earnings collapsing. So you can see the sheer number. This is what's called the slippage ratio. It's the amount of the percentage of their book that turned bad. Now, that basically caused a very sharp decline in profitability, as is clearly evident where you can see these numbers having fallen substantially. But as this pain was actually normalized, right, and you can see the gross NPAs actually reducing across banks that we're looking at, you're starting to see ROEs clearly improve. And along with this, your firms are starting to get re-rated accordingly. So this is kind of like within financial services. It's an example of a microtrend. There are specific types of banks, primarily corporate-facing banks that face specific asset quality issues. We identified that the worst of that is behind us, and there's going to be a path towards an improvement in earnings over the kind of coming 3 to 5 years. And that's really the trend that we're playing on the asset quality normalization microtrend. Companies that we hold here include SBI, Axis Bank, IDFC Limited, and Shriram Finance. Coming to lending franchises, this is really a play around the fact that there are certain very high quality lending franchises, right? And HDFC Bank and Kotak Mahindra are very good examples of the same, that have just been consistently year after year been able to grow at a very healthy check and avoid any major accidents in terms of corporate quality or in terms of asset quality. Now, what has happened is while they have continued to do well, and these managements, one, are also very dynamic, a lot more aggressive in terms of growth, willing to adopt technology a lot faster. You've had the entire PSU space really struggle a lot. So you've had a consistent decline in market share of PSU banks, which has been taken up by these private banks. And these are really the kind of companies that we're gaining exposures to. And if you can see, this has allowed for a very consistent growth rate in advances for these kind of companies. And even while they were growing at very rapid paces, asset quality has pretty much remained under check. No major negative surprises, leading to very consistent and healthy return ratios. So within the kind of lending franchise microtrend, we really have banks such as Kotak Bank, HDFC Bank, and ICICI Bank. These are our key exposures in this particular space. I think the consumer aspirational theme is well understood as one of the most recognized macro trends that are likely to play out in India over the coming decade. But really what you're seeing is that over the coming 10 to 15 years, you're likely to see a sharp improvement in the income profile of the Indian household. And you also have a very large amount of the youth, which is currently not kind of earning, actually entering the working age group. And they also have very different aspirational levels, very different spending habits. And this is likely to drive discretionary consumer spends in a very big manner. Globally, whenever an economy has crossed that $2,000 per capita income mark, you've seen a strong growth in discretionary income spends, discretionary expenditure, and you're expecting to see something similar play out in the Indian context. Now, with penetration rates of India is across a wide range of consumer categories, is substantially below that of peer nations. And this kind of leads to a very strong headroom for growth. So companies that we're looking at in the consumer aspiration microtrends include companies like ITC, Titan, and Jyoti Laboratories. Chemicals, API, and CRAMS, really, this is a larger play on the fact that China used to be extremely dominant in this particular space. And a number of different factors, including geopolitical concerns around China becoming too strong, some amount of risk mitigation post seeing what has happened to supply chains post COVID, increasing cost of doing business in China, right? All of this is leading to a larger global move of wanting to de-risk the supply chains from China dependence. Now, in the chemicals, API, and CRAM space, India has very strong in-house advantages around our understanding of chemistry and pharmaceutical chemistry, as seen in the dominance of a pharmaceutical industry. We believe there's a very large potential for this shift away from China to actually benefit India. And that's really what we're seeking to play in the chemicals, API, and CRAM space. And this is where we hold companies like a Syngene, a PI Industries, or an Aarti Industries. There's also a larger play around capex revival that we're quite enthused by. This is basically driven by a sharp reduction in corporate tax rates that has allowed manufacturing or new manufacturing units in India to become a lot more tax efficient than they were in the past. This combined with a very clear thrust by the government towards trying to revive the entire capital goods sector, manufacturing, etc. You're seeing the sheer pace of quantum of increase of government capex and very, very attractive PLI incentives that has really led to a very attractive pipeline of capital expenditure that is expected to actually come in over the coming years. So this is kind of a theme that we're playing through the likes of an ABB, Bharat Electronics, Thermax, and Reliance. A digital disruption is something that any of you on any of our other webinars, we are so optimistic about this theme that we believe we actually have a dedicated strategy that will invest exclusively in digital platforms, but it also accordingly finds its way into the micro trends portfolio. Effectively, we believe a combination of as a very strong foundation in place for increased penetration of digital services going forward, along with change of customer behavior, etc., is likely to drive sustained very high growth rates for digital platforms. And we've done a lot of work in terms of understanding how long-term profitability is likely to emerge at very attractive levels. A combination of strong growth and shift towards profitability is likely to lead to very attractive value creation in this space. And in this space, we hold companies like a Nykaa, a Zomato, Policy Bazaar, and a Paytm. IT services is also a space that we're optimistic on over the longer term. I think all of us are quite aware about the sure strengths of India's IT sector and the kind of dominance we've been able to build in terms of IT services outsourcing from a global context. This is a trend that we believe is fairly evident and prevalent, and the sheer momentum around increased digital spends should actually really play out well from an Indian IT services perspective. There are some near-term headwinds in terms of the weak global economy. And therefore, while we have an exposure to the space, it is only to one of the leaders, which is Infosys. And we actually underweight this particular area. But this is clearly one of the spaces where we believe as the economic environment improves, we could really start building on some more exposures here. A last couple of kind of micro trends, real estate is something else that we are very confident about. A combination of relatively stagnant real estate prices over the last decade, combined with a continued rise in household income and falling interest rates, has actually helped affordability come to an all-time kind of a high. Now, this improved affordability combined with the fact that there's been a lot of pain that the real estate sector has seen. A combination of demonetization, RERA, the whole NBFC crisis that has impacted funding for real estate players, and GST. And lastly, COVID has really led to a lot of the smaller developers really struggling to stay afloat. You've seen a sharp rise in defaults and also accordingly a very large number of developers actually leaving the market. This is leading to a much faster than expected formalization of the real estate sector. And since since all of the listed players are all larger organized players, there's really a large value migration that's happening towards them. So within kind of real estate, we have investments in DLF and Shoba. That's the broad thing. I just wanted to I spend some time really going through the portfolio and the portfolio construction in the specific companies, uh, with the hope that will help you get a better understanding of the way we look and identify the specific pockets of growth where the most attractive value creation, where we believe the most attractive value creation is happening from a market. I'll just go quickly through certain elements around Valkyrie's core GQV framework, right? In terms of what is our investment philosophy when we are looking at buying companies. So we have a framework which is the GQV framework, where we focus on growth, quality, and value. Right now, when it comes to growth, we clearly believe that growth is the primary driver of business value creation. And we're accordingly seeking to invest in companies with sustainable medium to long term growth potential. The focus is always on the medium term outlook, and we're trying to identify specific economic, sectoral, or business trends that will support that growth outperformance to the market. And we're focusing on business growth because we believe business growth will translate to market capitalization growth over the medium term. It's important to understand that our focus is on future growth potential and the sustainability of the same, not just on how a company has grown in the past. Quality is also something which is clearly incredibly important when we are looking at companies that we're investing in. So the aim is to invest in high quality businesses driven by their competitive moats, management quality, governance, and financial strength. We have various factors that we look at while evaluating the strength of the competitive moats, the quality of the management, governance standards being followed, and the strength of its financials. Lastly, while we're seeking to buy high quality businesses with clear growth potential, we want to ensure that they are available at the right price. So we recognize that business value is intrinsically linked to quality and growth, and we accordingly will be willing to pay higher multiples. Now, a bit about ValCreate PMS. So ValCreate stands for value creation. We got a license in 2017, and I joined in 2022 as the CIO for certain IME branded strategies. The core team, which comprises Rajesh and myself, have fairly deep institutional investing pedigree with over 5 decades of experience in some of India's largest CMCs. Now, these institutional best practices of fund management is what we bring to ValCreate. And the aim is to be able to offer differentiated investment strategies that offer exposure to specific underlying themes where we really believe value creation is a lot more possible. You'll see this is an underlying theme across the various strategies that we launch. So the aim is really to take this very deep institutional investing pedigree and be able to launch more differentiated strategies that would typically not be available in a mutual fund type of a construct.
Okay, so thank you again, everyone, for attending our webinar. And if you have any questions, please do reach out to me. My number is 9739112869. I guess it should have been displayed, but so thank you everyone for attending, and have a good day. Thank you, Ashi.
Thank you, everyone. Thanks for attending. Do a great job. Thank you.